Hello, everybody. So I have not covered Opendoor in a while because Opendoor is a position that I'm not worried about at all. And it is under 1% of my portfolio. Actually, with Tesla going way up now, Opendoor is like 0.8% of my portfolio. So I'm really not, this is a stock that doesn't worry me. Opendoor doesn't worry me. I've done the math multiple times. And I know that it's highly unlikely that they'll go bankrupt. Despite everything you read and see in the news, it's highly unlikely. I did a whole video about Opendoor. By the way, my channel, as I calculated, I went back, it has close to 20 different videos like this one on Opendoor. So I know Opendoor is not going bankrupt, or at least I know it's highly unlikely. And I'm planning of owning this stock until 2030. So whether the stock goes to 0 and then becomes a tax write-off, or goes to 100 and then maybe, who knows, maybe I'll keep it, maybe I won't, I don't know. But wherever this direction goes, like it doesn't really, it doesn't really faze me, because that's proper risk management, right? When you have less than 1% of your portfolio in a stock that is more for stock that's in turmoil, in a contrarian position. I would call Opendoor a contrarian position. It's a stock where very few people agree with you on. When you have a position like that, it's okay. I believe it's okay. And actually, I'm going to do some outlook calculations at the end of the video, and you'll see why it's okay. Because Opendoor could be a 20x in little time, if I'm right. And so if you have a 1% portfolio position who does a 20x, then all of a sudden it could become the biggest position in your portfolio or close to it, just by the nature of the asymmetry of the risk. There is high upside asymmetry, high risk asymmetry, but risk in the case of Opendoor, I believe, is way to the upside. That's where most of the risk asymmetry is. So, and again, why is this stock so cheap? Why is this stock so cheap? Because the market gives this company no credit whatsoever. It gives it no credit for innovation. It gives it no credit for technology. So this company has business model innovation. It has technology. It gives them no credit for that. It gives them no credit for execution and the speed at which they've grown within the past 10 years. No credit whatsoever. And it only looks at macro, and the market is such a short-term thinker. Market thinks, oh, real estate dead, rates up, Opendoor, boom, sell it off, put it away. And it's baffling. Frankly, it's baffling, because I listened to the whole call, 40 minutes, not a single red flag. In fact, a bunch of good things. And analysts were so lethargic on the call. The questions were so bland. It's an opinion. I'm not saying it's, they're so bland. I'm baffled. Like you even had an analyst asking what was the value of listing a house with Opendoor. Like, I made a video about this 3 months ago. Like, the analyst, I doubt that analyst who had that question ever bought a house, actually, because he didn't even know the usual cost of selling a house. I doubt that analyst has ever sold a house, because he didn't know the cost of selling a house with traditional agents, and he didn't know whether Opendoor was competitive. Well, I'll give a hint. Yes, it's competitive. It's much competitive. If you sold a house with realtors before, and you've sold a house with Opendoor, I've done both. I've sold a house with Opendoor, and I've sold a house with realtors. I can tell you, Opendoor is leaps and bounds better. It is a 10x improvement over a traditional process. So no credit on technology. The market gives no credit on technology. Market gives no credit for Opendoor on business model innovation, and just focuses on Fed raising rates. And so I just want to go over a little bit over the stock again, based on the call. So this is probably if you've been following my channel, this is probably the part that's more interesting to you, is what are my takeaways from the call now that we've ended 2022 fully, right? This is Q4 2022, full year 2022. So what do we know? Well, they keep unloading the homes that they overpaid for in Q2. We know that Opendoor is losing money on those homes. It overpaid, right? It made a mistake, a big mistake. But trusted the Fed. That's what happened. Many companies got caught like that. That's why we have so many layoffs today. So they'll keep losing money on these homes that they're trying to unload still today. They're going to post negative margins because they're going to take a loss on these homes. So we expect more negative margins in Q1 and more negative margins in Q2. But they will get back to positive margins in Q3 and Q4 of 2023 because they have been making, ever since Q2, they pivoted to low ball offers. I'm caricaturing, but it's what I call low ball offer. They make offers with bigger spreads now. They're much pickier. That's why their revenue is so down, because they don't look after growing revenue anymore. They just look at the economics of each home they buy, and they try to maximize the spread, try to maximize the margin between what they buy them for and sell them for, and they do that because of the current market. And they also do that because they're baking in negative home price appreciation in their forecast whenever they buy a home for their first party product, for their home buyer business model, the first party model. They are not only lowballing but including negative HPA in their forecast. They made a mistake, they've paid the price. You bet they're not making that mistake again. So now, what else they are doing? They're reselling their Opendoor homes, all of the homes that they buy. They're trying to push exclusives and sell them for exclusive. And I made a whole video about Opendoor exclusives 3 months ago, about all of the advantages of Opendoor exclusives. They're shooting for 30% of all of their first-party purchased homes sold through exclusives. So they're rolling out exclusives throughout the country. They're also hoping that when a buyer comes to opendoor.com and asks for an instant offer, they're hoping that that buyer, if unsatisfied with the lowball offer that now Opendoor gives, if unsatisfied, they're hoping that that buyer will choose to list their home with Opendoor as an Opendoor exclusive. Opendoor exclusives operate entirely outside of realtors. This is entirely operated outside of a realtor market, right? And they're hoping that they'll list it with exclusives, and there's many advantages for listing with exclusives if you are a seller of home. And I can tell you right now, whenever I have another house, my house, if I want to sell my house, I'm going to go with third party or first party, but likely third party, because I like third party even better, actually. But the third party platform is very, very, very valuable to sellers because, first of all, it's 1% cheaper. And the CEO on the call has nothing against dropping it. They say right now it's 1%, but if they're testing it, it could be 2% cheaper than a real estate process. They charge only 5% instead of 6% if you go with a traditional realtor as a seller, right? Because you have to pay for your buyer and you have to pay for yourself. You get stuck paying for both agents when you sell a house. That's the current system. You only have 1 day of showings as opposed to months, and sometimes multiple months if you accept an offer and that offer backs out for, I don't know, they don't like the faucet anymore. There's a tiny issue with the inspection. Some buyers get scared and back out really, really quickly. The game of the traditional real estate market is all about putting as many contingencies in there so that the buyer backs out. And that's fine. I'm okay with those contingencies. But the big advantage is that with Opendoor, if the buyer backs out, Opendoor steps in and buy the home. So you have a cheaper sale process, 1 day of showing. You pick an offer. If you get an offer, right? You could not get an offer, but if you get an offer, you pick an offer. And if you accept an offer, whether it's from a hedge fund partner, whether it's from a traditional buyer, and by that point, right, you would have rejected the offer that Opendoor gives you by that point. You accept your offer, and then if the offer doesn't go through, Opendoor steps in and buy your house so that you don't have to go through 2 or 3 agreements to finally sell your house. And I think this is a very, very valuable thing. Of course, contingencies are very important if you're a buyer of a home, but in the case it doesn't work out, Opendoor is there to be a liquidity provider at the end of the process. So the third-party platform and selling with third party is very, very powerful. This is what else is good. So Carrie Wheeler was asked a question by an analyst about when she thinks there will be a return to normal. And this was the most interesting part to me because Carrie Wheeler did not give outlook. She did not give guidance, but she did say something about 30 minutes into the call that really made me bullish on the company, even more than I already am. And she says that if the market gets back to what it used to be in 2019, she expects $10 billion in annualized revenue by the middle of 2024. And she highlighted a few assumptions for that expectation, that long-term expectation in revenue. 10 billion in sales, annualized sales, middle of 2024, assumes that we go back to a normal housing market, same as 2019, assumes that they achieve similar success in each market as 2019, assumes that this success is achieved in all of the markets that we're in today. We're in 4x as many markets today as they were in 2019, and it does not assume, so this is bullish, this is good for us, it does not assume any benefit from brand awareness or channel partnerships such as Zillow's. And when I hear this, I see this as a long-term target that Carrie Wheeler is saying. She's saying $10 billion revenue by the middle of 2024. So that's enough data to do some math. So please allow me to do some back-of-the-napkin easy math. So if she's saying she's going to have a $10 billion revenue run rate mid-2024, that would mean that she's quote-unquote guiding for a $2.5 billion in revenue for Q2 ended 2024, so a year and a half from now. Now, we don't have data for 2019. They were in public back then, but we have data from the earliest data that I could find was Q3 of 2021. And I believe Q3 of 2021 was, it was still a hot market, but it was not exactly the spring. So it was not exactly the bubble that really we hit in February of 2021. And in Q3 of 2021, so right, September 2021, for the 3 months ended, they add $2.26 billion in sales, and their market cap was $11 billion. Again, this is not the high point for Opendoor's market cap. The max they went to was $19 billion. So the midpoint at $11 billion, and you do that over quarterly sales of $2.26 billion, you realize that their price to quarterly sales ratio is 4.85. So take this 4.85, right, multiply the $2.5 billion in revenue that we are assuming for them in 2024 by the same ratio that we had in 2021, and you get a $12.17 billion market cap. Now, let's assume that there's going to be stock-based compensation, a little bit of it, so that the share outstanding count goes up, say, to 650 million. And when you take the new share with a dilution, assuming there's going to be 650 million shares in 2024, divided by the market ratio, right? That ratio divided by that ratio, you get a share price of $18.72. Right, $18.72. So $18 share price, right? So we take, I'll go through this again. We take the quarterly sales, multiply them by the same ratio that was then in 2021 that was applied by the market. We get $12.17 billion in market cap theoretical. And then we divide this $12.17 billion theoretical market cap that we would get in Q2 of 2024 by 650 million theoretical outstanding shares, because we assume some stock-based compensation. And if we do this division, we get to $18.72 in a share price. Compared to the stock price today, before the drop after hours, actually it's 22 times bigger if you take into account the drop after hours. But without that, and you do it because you use a current price of 182 at closing today, you're at a 20x potential just by doing this back of a napkin math. So the implied price target of what she said on the call, when I do my very simplistic back of a napkin math, is a 20x. It's a 20x return. And by the way, if I were to do something even more simplistic, which is that I would assume that Opendoor will get back to all-time high as obviously, if you're a long-term growth stock, you're going to beat your previous all-time high on a fairly frequently basis. If you are a long-term thesis, and if you have a positive long-term thesis, well, that would apply a 32% return, a 32 times return if it were to go back to the all-time high level that it had. So I realize these numbers look silly. Of course, I believe the number that I calculated based on what Carrie Wheeler said on the call to be the more realistic, which is a 20 times return within a year and a half. Again, very simplistic stuff. And I realize that could look silly or stupid. But my calculation is really a routine one. You're taking a prior price to sales ratio, and you apply it to a future sales number to derive the price. I mean, it's a very routine one, and this is based on the information that the CEO gave. So it's not, it's not very that far-fetched. People do that with P ratios all the time. So, what can I say? Well, what I can say is that this stock has been so punished by the market, it is really, really hard to believe. And my opinion on this is this stock is all about a bet on the housing market. And do you believe, like Carrie Wheeler believes in the call, do you believe that the housing market will get back to normal halfway through 2024? And I'll say, I don't know if it's going to be halfway to 2024, but I do know one thing. I know that it's going to get back to normal someday, and probably much sooner than most think. And this is in line with my strong opinions on monetary policy. If you've seen the few videos that I've made on monetary policy on the channel, you know why I would be bullish on Opendoor. This channel is called Beat the Denominator. I plan on covering more monetary policy stuff, but it just so happens that people are not as passionate about monetary policy. But I can tell you one thing is that the Fed has to re-enter quantitative easing. That's my truth. That's what, this is not influence. This is not me hearing anybody else. This is not me listening to Chair Powell. I don't listen to Chair Powell. He has lost all credibility in my eyes. This is me just looking at the numbers. And when I look at the numbers, I realize that without QE, if there is no QE, there won't be enough buyers of U.S. Treasuries. Period. China's not buying nearly as many U.S. Treasuries as they ever did. Right? Social Security is not buying much. There's not gonna be buyers of these treasuries. It's gonna have to be the Fed. If it is not the Fed, I don't know how the U.S. government will work. The U.S. government will probably keep taking money out of pensions, out of a whole bunch of different government entities. There is just no way. Those treasuries have to be bought, and they can only be bought if the Fed resumes quantitative easing, i.e. prints digitally, to quote Chair Powell, prints digitally base money and buys those treasuries with base money. That's as simple as that. But that's not it, right? You may even say it's beyond the government, right? Companies, states, cities, pension funds, households sometimes if they have credit card debt, can't roll over the debt at current interest rates, right? How many zombie companies do we have? How many zombie cities and states do we have who can't roll over their debt at the current interest rate, right? Because if they did, they would go bankrupt, or they would have to lay off everybody, which many companies are doing. So again, QE has to happen. Otherwise, you're going to have some sort of a financial catastrophe. That's going to make 2008 really, really pale in comparison, right? And so I believe this is what happened, and this is true for federal government, zombie companies, leveraged pension funds, states, cities, households. What else? Well, I'll finish with this. And this is part of my thesis as to why I believe the Fed will pivot. Who's buying mortgage-backed securities today, right? Who's buying MBS, right? The Fed is a missing buyer right now. The Fed is not doing QE, so the Fed is a missing buyer. And if the Fed keeps being a missing buyer of mortgage-backed security for any greater length of time, make no mistake, there will be major collapses of financial institutions. Because financial institutions fund mortgages package them into mortgage-backed securities, and then sell those mortgage-backed securities on the market. And if the Fed is not there to buy, there is going to be a catastrophe in waiting, because they are not going to be able to unload all of these mortgages, and you would have a chain reaction a la 2008. That's what would happen. So I'm not worried at all. The market is not worried either. We know that the Fed has to resume quantitative easing. We all know what too big to fail means, right? If you remember 2008, you remember the huge list of financial institutions who were put in this systematically important financial institutions. And they got bailed out. And so now it would be a good time to study the past and look at what has happened in 08, 09, and what the Fed did. And, if the Fed plunges us again in a similar situation, I believe the Fed will have no choice but to respond to the issue once again with ever more QE. That's why a lot of people, I say QE to infinity. That is the only way. And we have the example of Japan. Japan has been in this situation much longer than in the US. So it is my truth. I hold this truth to be evident, right? That a pivot is on the horizon. Maybe it's not going to be in 2023. Maybe the Fed is going to keep bluffing for an extra, 10 months. But every year we wait means that we are going to get an even more massive quantitative easing later on. So you're just delaying the inevitable. And, I'll be holding Opendoor. Because I don't think Opendoor is going to go bankrupt before the QE resumes. So I'll be holding Opendoor. So to me, in conclusion, Opendoor is a bet on that recovery in housing that will be macro-driven. And in my view, Opendoor has enormous risk asymmetry to the upside. We have 3 plays in one. We have a macro play, we have a technological play, and we have a business model innovation play. And it's all converging in Opendoor. And when you go back to what I was saying about the potential, the easy calculation potential of that 20% return right here and an $18 share price, you can also understand why I'm fine with just a 1% position, 0.8% position. I'm fine with that, because if that happens, then all of a sudden Opendoor becomes 20% of the portfolio. That's the beauty of sometimes having stocks that can show explosive growth and explosive price appreciation, as risky as they may seem. For Opendoor, I believe the downside is limited. The downside is you lose everything. That's the downside. It's limited compared to a 20x. There's companies that you invest in, you may lose everything that you've invested in that company, but that company has a 20% upside or 50% upside. That's not good risk management. That's not good risk asymmetry. You're talking about a stock here that has a 2,000% upside. So anyways, I'm done with the rambling here. Thank you so much for watching. This is not investment advice. This is just entertainment. Please like, please subscribe, and follow me on Twitter if you can too. I really appreciate any subscribe and like I can get. Sorry if this video was a little clumsy and all over the place. I'm tired today. But anyways, have a great day. Good night. Goodbye.